Log into any retail brokerage, institutional trading terminal, or charting software and open the Relative Strength Index. The look-back period, the amount of historical data the indicator uses, will default to exactly 14. The RSI is the foundational momentum oscillator of modern technical analysis, measuring the speed and magnitude of price movements to determine if an asset is overbought or oversold. From large-cap equities to foreign exchange pairs and decentralized cryptocurrencies, analysts and automated systems accept this 14-period parameter as the absolute standard. But if you trace the math back to its origin, you have to ask, where did this specific number come from, and why does everyone use it? We need to look closely at whether anyone has actually tested the mathematical validity of a 14-period look-back window against the microstructure of modern high-speed markets. Relying on an unquestioned legacy parameter without knowing its origin introduces a consistent blind spot into any trading algorithm. To understand the friction between this tool and the current market, we have to look at the environment where the RSI was actually built. In 1978, the market was a physical, manual reality. Trades were routed through human brokers, shouting orders across crowded physical trading floors. Execution was constrained by the limits of human vocal cords and handwritten order tickets, creating constant delays and inefficiencies. Price data arrived slowly and linearly, printed out symbol by symbol on physical paper ticker tape. Assets were priced in fractions, like eighths and sixteenths of a dollar, and updates happened at a glacial pace compared to the continuous pricing we see today. Compare that historical friction to modern electronic exchanges. Floor traders have been replaced by server racks and quiet, continuous data feeds. Pricing is decimalized, and high-frequency algorithms execute thousands of orders in milliseconds. Applying a 1970s assumption to a 2020s market structure uses a framework built for a level of friction that no longer exists in modern data streams. Let's isolate the mathematical engine of the RSI to see how it actually processes data. At its core, the indicator compares the average magnitude of upward price movements to the average magnitude of downward price movements over a specific time frame. The entire calculation depends on the N variable, which dictates the look-back window. This represents the number of periods, usually days, that the formula averages together. This N value functions as a sensitivity dial for the entire indicator. Decrease N and the mathematical output becomes hyper-reactive. The indicator line oscillates wildly, creating a jagged profile that triggers signals on almost any minor price fluctuation. Increase N and you smooth out the data points. The indicator becomes a slow, lagging curve that takes significant time to register changes in momentum. The core formula is sound, but its accuracy relies entirely on selecting the structural input for N that matches the asset's behavior. In 1978, a mechanical engineer turned technical analyst named J. Wells Wilder published New Concepts in Technical Trading Systems, introducing the RSI to the public. Wilder operated on the philosophy that market prices do not move randomly, but rather oscillate through predictable, fixed time cycles. He built his new tool around one specific operating assumption, that the standard cycle of a market lasts exactly 28 days from low to low. In classical cycle analysis, the most efficient look-back period for any momentum oscillator is exactly half the length of the dominant cycle. Divide Wilder's 28-day market cycle by 2, and you arrive at the standard 14-period input. Wilder selected the 28-day cycle because it closely tracked the lunar cycle, a common heuristic technical analysts used in the 1970s to establish a baseline rhythm for the market. That means modern algorithmic traders, executing millions of calculations a second, are unknowingly calibrating their high-frequency models to a 1970s assumption about moon phases. The issue goes deeper than the lunar cycle. We have to address market microstructure, specifically the impact of designated trading hours. The 1978 New York Stock Exchange operated strictly 5 days a week, shutting down entirely for weekends and holidays. In that environment, 14 trading days actually represented almost 3 full calendar weeks of market action and price digestion. Now look at modern cryptocurrency and foreign exchange markets, which operate continuously, 24 hours a day without ever pausing for a closing bell. These networks never sleep. Price discovery continues seamlessly through Saturdays, Sundays, and major holidays. A 14-period window on a daily crypto chart covers exactly 2 calendar weeks, this feeding the algorithm less calendar history than Wilder designed it for. In signal processing, this creates a specific error known as phase misalignment. When you force a static 14-period tool onto a modern asset that actually operates on a 10-day or 40-day empirical cycle, the indicator moves out of sync with the underlying trend. The indicator falls out of rhythm with the asset's true peaks and troughs, measuring momentum over a window of time that no longer reflects the asset's actual cycle. The structural friction between 1970s equity hours and modern continuous networks increases the probability that the default RSI will generate lagging or misleading data. We can see the mechanical failure of phase misalignment in the most common trap modern traders face, the false reversal signal. It happens when the indicator screams that an asset is overbought, prompting a trader to sell, while the actual price continues climbing relentlessly. Here, the price makes consistently higher highs, but the static 14-period RSI hits the 70 threshold and flatlines, failing to map the ongoing momentum. The mechanical reason is straightforward. The 14-period window is simply too short to capture the true, longer dominant cycle driving the trend. Because the calculation is phase mismatched, the indicator hits its upper mathematical bounds and gets stuck there, while the underlying price discovery continues expanding. A false divergence like this isn't a failure of the RSI's math, it is a direct consequence of the user selecting the wrong lookback period for the asset's true cyclical behavior. To solve the 14-day fallacy, we have to abandon the default setting entirely and use a process called dynamic calibration. Dynamic calibration means measuring an asset's actual empirical cycle before you ever set the indicator's lookback window. The updated rule of thumb retains the half-cycle theory, but applies it to real data. Measure the current dominant cycle of the specific asset and set the RSI to exactly half that length. If asset A exhibits a 20-day cycle, you set the RSI to 10. If asset B operates on a 60-day cycle, you set the RSI to 30. Measuring cycles is not about predicting the future or finding a holy grail setting. It is purely an exercise in statistical alignment. Because markets are dynamic, volatility and momentum cycles change over time. The look-back period cannot be set and forgotten. It requires regular, empirical updates. True algorithmic edges are found not by trusting universally accepted defaults, but by rigorously aligning mathematical tools to the specific reality of the data.